Okay, welcome to today's special podcast where we are fortunate enough to be joined by a veteran of the trading world, Gary Barton. He is someone I personally follow for his expertise in technical analysis, and certainly someone I would recommend any listeners to consider following and learning from. At present, Gary trades the futures markets, largely focused on, I believe, the ES and silver contracts. So for any newer traders and investors present, ES contracts simply represent the E-mini S&P 500 futures contracts that tracks the S&P 500 index. So look, Gary also presently coaches in technical analysis with the Australian School of Technical Analysis. I would highly recommend checking out the website and also his book, Guide to Rule-Based Trading Systems. In addition to this, he also provides FP Markets with a weekly in-depth black and white report, which is something I personally read each week and would certainly recommend to any interested technicians. I will ensure listeners will have access to all of these said links, so do not worry about that. So without further ado, welcome, Gary. Thank you very much for taking the time out of your day to join us.
Thank you, Aaron. It's a pleasure.
Excellent. So now, look, I understand you will take us through the your black and white report today and explain its structure for some of the listeners. So I'll hand the reins over to you, Gary.
All right, thank you. Do I need to press something here, Aaron?
Yeah. So share screen. I think.
Share screen, of course. Yeah.
Yep.
Okay. All right. So you should have my PowerPoint presentation up there.
Yep, that's all good, Gary. Thank you.
Okay. So let me go through this and go from here. Okay. So thank you very much, Aaron. Now, the black and white report I write for FP Markets every week. It's done across the weekend after the markets have closed on a Friday. And there's what I wanted to do was just go through the structure of the charts and how the black and white report is put together. Because when you look at my charts inside the black and white report, there's a lot of detail on there. And I tend to leave the hindsight comments on the chart. So, and every technician I think should, so that you can see what often repeats itself on a chart, in chart action, particularly at swing points, turning points in the market. And then you can also see how often you're wrong about your decision process and as you go along. So I just wanted to go through this and point out that the black and white report is on the FP Markets website. It's free. There's no sign up. If you go to the front page of the website, you can go to resources, and under technical analysis, you'll see some of Aaron's great work there as well, which I have a lot of time for. It's a very, very detailed FX work that Aaron does. And you'll also see my black and white report there. Now, the black and white report is really to give traders some guidance, if you like, into what might come in the coming market as it comes out on a Monday morning. And it's based around this kind of Dow theory concept. Now, I'm very, very big on Dow theory. I think that a lot of people think Dow theory is old school and all the rest of it. It's probably more relevant today in today's market, particularly this bear market, more relevant than ever. And we'll go through the concepts of Dow theory, then I'll show you on the charts how that actually works. So the markets, the Dow's theory, or Dow's theory is based on one particular concept, that markets can anticipate economic turns well in advance of the ordinary observer. You and I are the ordinary observers. So it takes this collective observation of the market, and often money comes into the market that we don't see, because why would they tell us? But we often see early investors, early traders come in, and we see market structure change when enough people believe that the economic future will be a little brighter than it is today. So Robert Ray, William Hamilton, they went on with Dow's theory, if you like, and they started to build price observations around that. that reflect the theory and the business environment at the time. The key concept behind this observation of forward economies, if you like, is always around these four things, which is your volume, your interest rates, your news of the day, and business confidence. And as we know, interest rates are a very big topic at the moment, with most central banks now in a race to get their interest rates higher to curb this potential inflation problem. So we're also seeing low volumes in the market at the moment, particularly in consolidation areas. We're seeing low volume, low participation in there at this stage. And of course, news of the day, that just affects for the day traders. And of course, then all of that comes into business confidence. So this is really where we start to see whether we're going to get recessions and going forward. So all of these things show up on the chart, and this is what we're really interested in. So the Dow's theory centered around two market observations. One was the industrials, which is the Dow 30 at the time, and the transports. And we're really quite interested in this chart here shows, and this was taken back in April 2021. And it shows the right-hand side of the screen. The top one is the Dow Industrials, and the bottom one is the transports. And it shows them both heading off in the same direction. So April last year, we had the transports and the industrials confirming each other, both going in the same direction, both heading higher, bull market underway, and really no evidence of any sort of structural change. Then as we got into March this year, we saw both of the indices turn down, and we had what's then declared. A lot of people think that a bear market is declared when you get a 20% decline. That's actually not true. A bear market is declared when you get the industrials and the transports confirming each other by trending lower. And we can see that the transports have, I'll just get at my little pointer. The transports have trended down, the industrials have trended down, and they're both confirming each other that there's a risk-off scenario. And currently, what's most interesting at the moment is currently, and I took this snapshot today, is that they're starting to swing. They're starting to swing a little higher, which is really interesting. A lot of people saying, is this the end of the bear market already? Possibly. These two are confirming that we're swinging higher. And as they take out previous highs, this will get really interesting. So, we may be in the next already in the next bull market. And I'll go through some structure and some charts in a moment that might show us that to be true. But this, for traders interested in this Dow theory concept, these two charts are worth keeping an eye on. The other one is, of course, the Baltic Dry Index, which is essentially your shipping of dry goods around the world. And that's currently, sorry, the earlier slide there was taken back in March this year. And currently, we're sitting around about the same value, 2145. So it's really not showing any great advancement. I mean, the cost of shipping was a huge factor in this shortage of goods. When the shortage of goods peaked late last year, we saw commodities and saw the Russian-Ukraine thing sort of really get under, or the noise around that get underway. But this has settled down quite nicely, and would be also worth watching going forward. So this Dow theory thing, it works around, and you'll see this in the charts. I have in the black and white report, I post two charts, a daily and a weekly of the indices, and the daily charts of some of the commodities. But it says that there are basically three movements which occur all of the time. The first one that we're most interested in is the primary movement. And you'll see my charts marked up, often with bars that have which we call impulsive moves. And they're often the beginning of what's called a primary trend. And we see these primary moves both in bull markets and bear markets. The second is this secondary consolidation. And this is what makes writing the report a little tedious at times when you see like oil at the moment. It's consolidating between a $94 support and $107 resistance. So oil is in a secondary, what we call a secondary movement. And these secondary movements, of course, can last from 3 weeks out to many months in there. And I'll show you some examples of that in just a moment. And the third, of course, is the daily fluctuation, which is where the day traders operate, really short-term traders operate, and we can see daily fluctuations based around news of the day, that type of thing, and current changing sentiments. So when we look at market structure, if you like, is that we get these periods of consolidation where a new low is made, market enters into a bear phase, confirmed into a bear phase, and suddenly we get a breakout again, and off it goes into higher highs and higher lows. So this structure about higher highs and higher lows is so important when you stand back, when you're looking at trading something, no matter what it is, when you're looking at trading something, this concept about higher highs and higher lows and lower highs and lower lows, of course, is so important in the larger time frame. So when you start to look at large time frames, and if you're a short-term trader, a large time frame might be the daily. If you're a longer-term trader, the large time frame is certainly the weekly chart. So it's worthwhile looking in those larger timeframes where things are really going to get a feel on the market. When we bring it just into a candle chart, we see the same thing. Market making new highs, making higher lows, and breaking out above the highs, and we see this uptrend in place. So just a little bit of information around that. These secondary markets, we often see fluctuations up to 5%, swings higher and lower in there. They become the important swing points for us, and we often see that these secondary markets can decline up to 33 or 66% of the actual advance of the previous advance. Well, I'll go through that as well. But this is a lot of new traders, if you like, look at these types of structures and go, okay, well, it's trending down. Well, actually, it's not. It's just simply consolidating into a secondary market, and before it resumes its primary trend. And so we see that in chart structure. As markets break out into new highs, we declare an uptrend in place. We're looking for that structure to remain in place. Large secondary movement in here. And then finally, we get this movement higher and higher. And then, of course, the issue with this is when you look inside, this is a weekly chart, this segment on the left here. But when you look inside these areas here, these declines, they often look like daily downtrends in the shorter timeframes, and with lower lows, lower highs, that type of thing on the way down. And go up one time frame into the weekly chart, and all you see is this orderly secondary decline where bars basically overlap each other. So an important observation is the structure of the price bars themselves. Do they overlap each other, or do they stand on top of each other as a primary move market? We can see, I've painted over it a bit, but we can see these bars up here basically standing on top of each other. And then this structure up here, they're overlapping again as the market moves back into a secondary phase. So the definition then of primary trends is where we have a low price, we make a high, and we make a higher low and then break into a new high is your definition of primary uptrends, particularly when you look at this inside weekly charts and longer timeframes, monthly charts at times, you see this primary trend. So we get this type of structure. So when we apply this structure, when I write the report and we start to apply this structure, all I'm really doing is describing what we see on the chart, and we look at things like gold and silver. Everyone's calling a bull market in gold and silver, but it's continually trending down. It's continually making lower lows. So that's really shows the sentiment behind the commodity itself. So downtrends, of course, we get the lower high and the market fails again, breaks into a new low, past the previous low or trough, and just simply heads lower. And this is the structure we're seeing in gold and silver at the moment. So in a chart, it looks like this. We have the lower high in here. Market breaks to a new low, lower high again, and lower low. And so we have a downtrend in place, particularly observed in these larger timeframes. So a very, very important observation when you start to build a picture of something you're going to trade. So a lot of charting programs have what they call a zigzag line. You can apply that in there, and I would use at least a 5 to 10% filter on your zigzag line. But again, I stress that inside large timeframes, weekly timeframes, often when you see a decline and look in the shorter timeframe, it will be trending the other way as a observable trend. And people think, oh, well, it's going down, it's trending down, but it just becomes part of the larger structure, larger consolidation, and often prior to a new move being made as part of an already established trend that's underway. So the secondary movements, I'll be quite brief with this, but the secondary movements, these are the areas where our bars essentially group up or overlap each other, become our secondary consolidation areas. And then we're looking for primary moves, the bars that stand essentially on top of each other, this one out to this one, and a very strong move up in here and here again, open to close is higher, open to close is higher, open to close is higher. So we have a primary move. We break our charts up into two groups, if you like, a primary move and a secondary move. And it's always the secondary move from it. I'm not here to talk about the trading side of it so much, but it's always the secondary moves that we look for information about a primary move coming or a primary move starting. And I'll show you that in the NASDAQ and the S&P 500 that's been developed over the last couple of weeks. So secondary consolidation, again, in a downtrend, are these areas here, simply where the bars overlap each other, this consolidation before potentially a primary move gets underway again. So again, very good secondary, primary observation of some price action. And the other markup I have on the charts is a thing called a fake out, an FO. I mark a lot of my charts with the fake out bar. And they're simply where a bar has moved past a previous high. So we have a previous high in here, market has moved down and done what the market's done. Then suddenly we've had this race up in price and it's gone past a previous high. Now, this type of fake out, this really, this kind of, a lot of breakout traders look for this sort of action to enter into trades. And I would argue that often this is the failure point, and evidence on your charts will prove that. If you go and study your charts, look at your significant swing points in your chart, the significant swing point here and here, and look at how they are structured against the past price action, where a lot of people say, oh, there's stop runs and there's this and that. Well, maybe there is, maybe there isn't. I'm not really sure on that. But I do know that there are a lot of traders see opportunity in taking profit off the table, particularly when you get large spikes in price like this one. If they've been holding for a while, they'll see an exit and simply take the exit out of there. So our chart is always marked up with this type of observation. Now I'm going to try and go to this week's presentation. Hopefully you can see that, Aaron.
No, I'm still on the the slide. Was you trying to switch to the black and white report?
Yes.
Yeah, it's just a new share. I think you have to stop sharing and then share it. Just click on the share screen. It will come up again.
Okay. You share. Oh, look at that. Okay. Is that it now?
Yeah, the summary. Yeah, there we go. That's it. That's correct.
Okay, very good. All right, so the black and white report. So the report is written around a series of charts that affect other things in the market. Like, for example, the gold and silver chart, of course, affect the gold and silver miners in particular. But more importantly, and so the black and white report has a little bit of my commentary at the beginning, and then we go into this price structure. Now I'm just going to try and bring this down a little bit. There we go. See how that works. So as I said, all of my charts are, I'm going to take it back to my 200. Okay. All of my charts are quite busy. And I leave all of my notes on my charts. And I encourage anybody that if you're looking to study technical analysis, leave all of your notes on your charts. It really offers you some insight into how past price action is often repeated currently in future markets. Like we can see here at the right-hand edge, we had a couple of impulsive moves down out of this secondary movement. So the index on a weekly basis, the index is actually declining. It's the index itself is in a bear market. But we have often these reversal patterns that set up these reversals inside a bear market. So we look at the weekly chart first, we declare, well, okay, well, there's a downtrend in place. And you'll also see that I have a thing called OPD, which is an outside range. It's a bar that has a larger range high to low than the previous bar. And the statistics around the outside range is just staggering, that when you see an outside range, particularly after a strong movement up or down, and you see an outside range, often that becomes the swing point and becomes a great marker to have on your charts to look at when that's broken in future price action, about which way it actually breaks. It's the high or the low. So this one, the XJO, we can see it's put in a large consolidation period across the top here, and then it's broken into this downtrend. Now, last October, I started to write up about this observation that this was consolidating. Very good chance that we're going to see a broad top in the market. If you look back into old black and white reports, it's all there. But we have this defined downtrend. So when we come into a shorter time frame, now, in this daily chart, we see that we've got this consolidation. What looks like a weekly side-by-side bar arrangement is spread out into a daily chart. Now we've got this pennant shape, which I believe has broken to the high side this week so far. So that was a good outcome. And I draw off the resistance lines just from previous high points and previous low points. Back here, you'll see the low points. I number them, just simply call them their support resistance areas, and they become, of course, the go-to levels. So when we get past those levels, it becomes an important observation. The other observation is you'll see inside these patterns, I mark them up with the lows: 1 low, 2 lows, 3 lows, and 4 lows here. 1 low, 2 lows, and 3 lows potentially here. And it turns out that we have got the third low here. The pattern developed on low volume. Good sign that the sellers are running out here, running out of ammunition. And we're seeing this breakout this week. So the commentary around that was that the daily chart displays a developing pennant. This is a continuation pattern against the prevailing downtrend. To negate this view, a close above 6765 is required. So we got that today. So it gives us a bit of insight into market, what we're looking for the market to do so that we can position ourselves on that side of the market. Just one issue around the Australian market, I would point out in the volume comments here, I mentioned that always a Friday's volume is quite low, low participation on a Friday, but we saw this low volume area pretty much over the last couple of weeks. And it's not an encouraging signal for new buyers entering the market. Now, I haven't seen today's volume, but there is a observation particularly in the Australian market, that when you get volumes over 1 billion on a daily basis, that tends to be the really strong indicator that we've got a swing point. And you can see it down in here. Back in January, we had a very strong volume day there, and that became the swing point again here in March, again in the mid-June. And it'll be interesting to see volumes currently on this breakout that we've got. So volume is an incredibly important tool from that point of view. Often the day-to-day volumes, we see 2 weeks of low volume becomes pretty much insignificant when it continues on. But then we look for the standout volume, and it gives us a very, very good insight into, and also I continually run comments from the previous week, which just to keep myself honest on that. What's really interesting about the S&P at the moment, I commented this week that the S&P is building support above 3715, and last week, the S&P on Friday put a high close in on the range of the week. So we see that the last bar pretty much closed towards its high. So the buyers have come in against all of that selling that sold it down to 3715. The buyers came in and really lifted the market back up to pretty much the open line. So we're seeing it takes a lot of conviction to do that. So again, I've simply mark off 4050, which was a previous low way back here. It gave a bit of resistance here back earlier this year, and the market has now consolidated above this 3715 area. When we go to the shorter time frame on the S&P, we see that, we come in here, and we see again the 3 lows, 1, 2, and 3, and we saw a breakaway gap on the Friday, which has resulted in our reasonable start yesterday and a better flow through today. But this structure, daily structure against the weekly structure, is important. When you observe your charts, when you're building a picture of something, try and use two time frames. Even if you're using 4-hour charts and daily charts, that's fine. But a two time frame structure gives you a real insight in there. You can see in the charts I've marked impulsive moves. These become the primary moves in the market, and so on. Interesting, our market is still a long way from the 200-day moving average, and I think it'll get fairly interesting if we get anywhere near that 200-day average. The other observation that I continually try and make is around relative strength. I think relative strength is one of the more important tools that traders should use. Relative strength is particularly in the look-back period, the 14-day look-back period. If you can find a divergence inside that period, it becomes really quite a powerful tool. And we saw that in the S&P in mid-June. There was this divergence where the relative strength put in a slightly higher low here, but the market itself put in a new low. And you look at relative strength from the closing prices, not so much the wicks of the candles, but the closing price, because relative strength is calculated on the closing price. So we're looking for a new lower close on there. So it's a great tool to keep an eye on, to run at the bottom of your charts, and in particular when relative strength moves over 50. So the two key areas that I look for are divergence below 30, some form of divergence below the 30 level, and if the relative strength can swing over the 50 level. And it's really quite simple back testing. You can see when the relative strength is over 50, the market really gets a bit of a wiggle on from time to time. But let me go back, particularly in the weekly charts. The S&P 500 spent most of 2020 and 2021 with a relative strength over 50, and then suddenly we diverged away as the market was moving higher, which led into this decline current decline that we've got. There's also a bullish divergence in the weekly chart on the S&P 500, which is worth also keeping an eye on. So it's the black and white report is simply built around those simple observations about higher highs and higher lows, that type of thing in daily timeframes and weekly timeframes. And we also saw in the NASDAQ 3 higher lows in the NASDAQ, and we've broken out through this high at the moment. And again, there was a divergent signal at the bottom. Now, so I would encourage, again, I'll say it again, I would encourage traders to leave all of their notes. Make notes on your charts. It doesn't matter if you're actually wrong. You'll see yourself if you're making the same errors all the time. You'll learn a lesson from that. And support and resistance is developed out of these swing high points like this one in here. And these current swing lows, they will become the support levels going forward should the market roll over. We're seeing the RSI on the NASDAQ also swing over 50 here. So it's worthwhile just keep it really simple. And as I'll just go to this, Aaron, and sort of point out, this is probably one of the most contentious issues for traders at the moment, that have this theory that gold and silver should rally when you start to see inflation. Gold and silver has resisted everything at the moment. It has resisted a war in the Ukraine. It has resisted inflation. It really has gone against the grain of everything. And it's not hard to see. This is a daily chart. We can see the major swings, lower highs and lower lows and lower highs and lower lows. So it's not difficult to say gold is in a downtrend. What is interesting at the moment is we've seen the relative strength swing below 30. So we would look for price consolidation. The relative strength swinging below 30 is a reflection of the overall decline in price, of course. Small upturns show that the momentum is simply losing strength. So I've had the relative strength do small upturns along the way. But really, price has ruled the day and it has turned lower. I would get really interested in this relative strength reading now, particularly in gold. Even if you bring it out to a weekly chart, you'll find the weekly chart's below 30 as well. But there was an outside range set up in gold 3-4 days ago. We saw a rally out of it a little bit earlier this week. And off this inside period as well. Inside periods are great little markers because you can trade the break of the high or the break of the low of an inside period. Really good short-term trading tool for in basically anything in commodities and FX, that type of thing, and in particular equity. So generally when you get a movement and an inside period, a break of that inside period, high or low, generally gives you a bit of direction in the next short term. So gold is trending down, and silver, tragically, is also trending, making new lows. But we have this interesting support level around this 1840, above $18 level in silver. So again, we're seeing the relative strength move below 30 in silver, and this is the place to be watching it for a major swing. We saw it below 30 back here in May. We saw a bit of a swing higher in through there. So there's nothing, my comment aside from the black and white report is there's really no structure in gold or silver to suggest that we've got any sort of bull market base or any sort of bull market structure in the next short term. And I mean the next short term by the next 3 to 4 weeks. There doesn't appear to be anything building here that would give us any encouragement there. So and one thing tragically, of course, for the Australian gold producers, a lot of people have been trying to buy Australian gold producers. But when you look at the price of gold in Australian dollars, this is in the black and white report as well, XAU, AUD, we can see this has also broken to a new low down here and has remained within this very large consolidation area below 27.12, above 24.77. This is the Australian gold producers are struggling on this. It may improve if the Australian dollar remains low, but this is really what's behind the likes of. And I was really surprised today to see Northern Star down below $7 at the moment. Newcrest is, I think, below $20 or around $20. And they're really nothing. There's sort of nothing to see in this space at the moment. But this is worthwhile watching this chart. If we see an uptick here, you'll see an uptick in the miners themselves. The thing that surprised me most this week was the breakdown in copper. And I mentioned copper a couple of weeks ago. I mentioned copper breaking below the $3.80 level is a significant development. And it broke down below this $3.80 level here. First of all, of course, below $4 and then below $3.80. It's really needs to find some support around here, around the $3 mark, $2.80 to $3 mark. So I've got support marked off at $2.98, which is back off this high back here, and where we saw some consolidation along that line back in 2020. So this will be an important area to watch going forward on there. So it really sort of gives you a bit of insight into, we're talking about Dow theory and the economies. This copper chart is a sign of what the bigger global picture thinks of the global economies, if you like. Copper selling down is not a great look. It's one of the key metals, as everyone knows, in pretty much every corner of manufacturing, household and industrial. And here we are, it's just getting knocked over dramatically. And of course, the volatility index, the Australian volatility index. Now, this is, the US have their VIX. We have one called the XVI, and this is essentially calculated the same way. It is looking at the forward, the cost of forward put options. So we go out 3 months in the derivatives market and look at the price of put options and look at how they're increasing or decreasing against the current month, and which creates this calculation inside the XVI. And we can see that this basically since April, May, June this year has remained relatively elevated. And this is why we've seen when this gets elevated, we see the market decline. It means that the underlying equities are being sold and the put option is being bought to protect positions and portfolios and such. And we see that there, so of course, when there's a lot of buyers, price goes up, volatility goes up, and this is what's reflected in the VIX here. So it's really nice when the VIX gets around the 13 level or lower, we start to see quite a bullish move in equity markets. And I would encourage listeners to go and read the report next week, and I think we'll find the VIX has dropped dramatically, or the XVI also has dropped dramatically, as we've got this bullish move this week. It'll be interesting to watch. So that's pretty much it, Aaron. There's a couple of other things here. The US dollar index is just plain bull market run at the moment. We can see a series of higher highs and higher lows in there. Again, 107.40 is a support point. It's the low of this bar in here. And 105.80 is the high of this bar, becomes the next support level. Interesting enough, we've got a little bit of divergence in the US dollar index. I think it's a bit lower yesterday and today, giving a little bit of encouragement to the equities market, but very important chart at the moment, probably the most important chart for global equities and commodities at the moment is this US dollar index. Still a long way off its historical highs, but it's in a primary uptrend, and we can't ignore that along the way. So that's about me. I'll just mention also, I mentioned earlier about oil being in a consolidation phase. Big support level on oil is $94. Big resistance level is 116, but I've marked off this 107.73. This was the all-time high back in 2014, and we've sort of come up and bounced around that level. So I would retain that as a resistance level in this current movement. So we saw oil again this week back over $100, and still a lot of work to do there. So the black and white report, if you follow the charts, you'll see I've marked off impulsive moves. They often follow through. Hammer bars are often swing points. This one here failed. That's okay. Then we had an outside bar in here that led to a break higher, that type of thing. So there's repeatable structure in the charts that if you read through them, you'll get a sense of some market activity that, what we're anticipating inside market activity. So this week in oil last week in oil, I should say, posted a fake out bar. Fake out bars are often reversal bars as it comes and tests a previous low. So we're seeing oil up a little this week, which is a good outcome. Again, off this fake out observation. And we saw the reversals. There was a high in here, and the fake out bars up through here led to this decline. So this observation of fake outs where markets test previous levels, really important observation, and often a trap for particularly new players. They think there's a breakout, but often it's just simply a retest. And so we're looking for swing lows, swing highs to go short, swing highs, and swing lows to go long in there. And we often see patterns around that, fake out bars at the low, 3-bar reversals at the low, that type of thing. Outside periods at highs become the swing point lower. And I'll just finish off on this, Aaron. I know I go on a lot about the outside period, but the statistics are dramatic. It's like a 94% outcome that if you see an outside bar, particularly after a sustained move, if you see an outside range, you often see that as a swing point, particularly when either side of that is broken. So that's me. I encourage people to read it, take it on board, use it as a guide, particularly as a sentiment guide in your indices, and good trading.
Thank you very much, Gary. That was excellent. I'm sure the listeners will certainly find benefit in that. I was just following along on the charts when you were speaking. Also on the Dixie, we've had some considerable divergence play out because your chart's 3 or 4 days back, I think. If you look at the Dixie now, it's we have negative divergence, early negative divergence on the monthly time frame of the Dixie as well. Negative divergence on the daily as well as the weekly is insane right now, all through the RSI. So, but look, I learned a lot from your black and white report personally, especially with the Dow theory as well, and also the RSI, which I use in my market analysis as well.
Yes,
and I mainly learned a lot from your work. Gary, I have a few questions, or a couple of questions, if you're okay with that.
Yes.
So what are your thoughts on? I've been asked this a number of times. What are your thoughts on those who say you cannot trade only technical based methods and be successful, that you need to include fundamental analysis? What are your thoughts on that?
I think that's half true. Let's get away from one thing first, is a lot of people think that if they learn more technical analysis, they'll become a better trader. Well, that's actually not true. I spent many years as a broker inside some significant trading floors, and there were guys in there who understood nothing about technical analysis, but did quite well on pure fundamentals. It took a little longer, but pure fundamentals. So from a technical point of view, where it's really often bought into a shorter time frame, and that's what a lot of retail traders, I'm a retail trader, that's what a lot of retail traders are looking for, is this shorter time frame swing. I think there is, as I mentioned earlier, the technical analysis of indices is a great sentiment tool. Looking at a changing sentiment as we see charts change trend. it becomes a huge sentiment tool. I do, as you mentioned earlier, Aaron, I do coach a few people from time to time, and we always look at the indices first to see what market sentiment is telling us. Now, indices aren't individual stocks. Absolutely. You'll see different thematic themes. Coal at the moment just going crazy, putting in higher highs. But we're seeing the index put in new lows. So the index is, it's not always reflective on equities. But as a general observation, I see the indices as a sentiment tool, and then go off and do your research on your individual stocks.
Thank you, Gary. Cheers. So look, my final question really is, because there will be a lot of newer traders that will listen to this, what's your advice for someone just getting started? Where would you advise them to begin?
Understand position sizing. Understand that your money management, if you like, is probably the most important tool that you have outside of my win-loss rate runs at about 50-50. Most trading systems I see, the win-loss rate runs at around 50-50. The win-loss rate is not actually that important. It's how much you hand back against how much you achieve on the upside of your trade, whether you're short or long. It's really comes down to money management, your position size. This swinging for a home run, you'll probably last about 3 months. If you understand position size, where you structure your trading into, if you have to take a stop loss, the stop loss becomes a fixed amount of your account, of your underlying account. So if, for example, if you had a $10,000 account, you decide to nominate 1% of that as your risk, which essentially is $100. You can position size around that, nominate where your stop is, you divide that risk into your $100, that will give you your position size. That is really the thing that gets left behind when people approach the market. They read about something in the papers, or they hear a rumor, or they on some social media site or something like that, and they go like, oh, they must know what they're talking about, all in, and they find out that everyone basically has a 50-50 win-loss rate. And that can clean you up very, very quickly, just being on the wrong side of something with a too large a position. It's really, I think that's one of the key aspects of trading. A lot of the people like coach, often people come to me and they like, well, just show me, let's just cut to the chase and show me what's the secret of all this. Well, the secret is actually your stop loss. That's the secret, is your stop loss. You look at any significant trader, Linda Rashke, for example, will talk about stop losses. Some of the more well-known traders are always talking about managing your risk, not so much managing your upside is easy, but managing your risk is the hard part.
Of course. There's also a segment
that's the bit that they should focus on. Yeah.
Sorry, Gary. There's also a segment in your previous webinars you did for FP Markets. There's a segment in that I would encourage anyone to, I'd encourage anyone to watch the entire segment, because it really takes you through the trading process and has a really important segment on money management and risk management, if I remember correctly, Gary.
Yes.
Yeah.
Yes, that's correct. Yep.
One more question, Gary. Trading psychology. What's your opinion on that? How important is that to you? And how do you emphasize that to your students?
Yes and no. I think there's a couple of things here. I read a really good quote the other day from a trading psychologist that said your trading outcome will only be as good as your opinion of yourself, which is mostly true, I believe. Because we have this issue with a trading outcome. Once the trade is finished, whether it's a win or a loss, in particular if it's a loss, we can't change the outcome. Most things that work against us in life, if something breaks or we don't like the color of something, we can go off and change it. We can manipulate pretty much everything around us, except in trading. We can't change the fact that the trade turned into a loss. or we took our trade off too early and left a lot of money on the table, that type of thing. I'm guilty of that. I'm here to tell you from time to time, but that's not the game. The game is to manage your rule set. The game is to manage your trading strategy there, and there will be losses, and so we often see, and I'm a great advocate of back testing by hand rather than using some of the back testing tools inside some software, because you back test it by hand, you get a real feel for what can go wrong in a particular, when you see a setup and it doesn't work, you get a real feel for that. But whereas the back testing inside software doesn't actually show you that, just shows you your drawdown and what have you. So yeah, trading psychology, yes, it's an important tool, but I don't think it's the be all and end all. I think it comes down to believing in your trading system, in believing into your own rule set is the answer there. Belief in something can be built by just simple back testing. I mentioned earlier RSI over 50. Go and check it out. See if it's true. You know, that can be a simple trading rule. And understand that when you look at your charts, when the RSI is over 50, there'll be drawdowns and of course advances. So that, I think, is a better structure to follow than thinking that there's actually something wrong with you, because there's nothing wrong with you at all. You're the same as everyone else, me, same as everyone else. Dealing with these losses becomes like hitting a brick wall, whereas in other things in life, we can change outcomes, and we don't get to do that in the market. And that's often the difficulty that people face.
I've never thought about it like that, that we can change things outside of life. I just never really compared that. It's fantastic. Excellent. So look, that's all the questions I have really for you, Gary. This has been, if you've got anything else to add, please do. I'm sure the listeners will appreciate that.
I would, particularly for new traders, I'd just say start off slow. Particularly if you're into looking at the indices, that type of thing, use the mini contracts. In FX, use a smaller amount. Structure your trades around position sizing, and don't give up would be my advice.
Yeah. Look, yeah. Gary, this has been a very insightful presentation, and one, look, I am sure listeners will appreciate as much as I have. So thank you very much for your time. And again, look, most appreciated. So with that, I will let you go. But I do hope we can do this again in the not so distant future, and maybe we can discuss charts together or something like that. And yes, please, again, for anyone that's interested in Gary's work, please be sure to read his weekly black and white report. It's uploaded on social media and through the FP Markets social media channels every week. And it's also posted, as Gary showed in his presentation, on the main FP Markets website under the research tab. And also do make sure to visit his website at the Australian School of Technical Analysis, and also consider purchasing his book. I've also purchased it, and it's a fantastic read. It's a no-nonsense approach, in my opinion. I hope you agree, Gary. It's a no-fluff approach, and this really, really drills down to the most important concepts, in my opinion. So look, on that note, enjoy the rest of your...
Thank you, Aaron.
Okay, thank you, Gary.
Thank you, Aaron. Thank you, FP.
So on that note, look, enjoy the rest of your day, Gary, and I hope we do catch up very, very soon. Thank you so much.
Very good. Thank you.
Thanks, Gary.